In this video, we're going to take a look at 3 popular high-yielding investments that are currently at an elevated risk of seeing a dividend cut. In the cases of all 3 of these investments, the main reason I believe these investments could potentially see a dividend reduction is because they've been reporting pretty bad financials that suggest they won't be able to fully cover their dividend at their current rate, or the management team has provided a poor outlook. I can't say these investments are guaranteed to go through a dividend cut, as they could potentially post some really outstanding results in their next quarter. But as I'll go into detail for each company, there's at least a strong likelihood of a cut happening because they aren't earning enough income to sustain their dividend at its current rate, or they're just suffering from harder times. The first stock we're going to look at that's struggling to pay its dividend is Ellington Financial, ticker symbol EFC. This company invests in a diverse array of financial assets, including residential and commercial mortgage loans, residential and commercial mortgage-backed securities, consumer loans, and asset-backed securities backed by consumer loans. They're an externally managed company that's classified as a mortgage REIT, although they do hold more than just mortgage-related investments. As of the making of this video, Ellington Financial has over $10 billion worth of assets under management. According to their portfolio summary, this company has 79% of its investments in credit holdings, which includes everything from residential loans, mortgage-backed securities, mortgage servicing rights, and consumer loans. 8% of their portfolio holds agency equities, which are investments that are fully backed by government-sponsored enterprises. And then 13% of their portfolio is in Longbridge, which is a reverse mortgage company EFC acquired in 2022. On the surface, Ellington Financial is a pretty appealing investment because their stock comes with a dividend yield of over 15% and it also pays monthly dividends. They switched to paying dividends monthly back in 2019, which they were able to grow right before the pandemic. After having to temporarily cut it, EFC fully restored it to its pre-pandemic level in May 2021, which is 15 cents a month. But given the company's past couple quarters, a dividend cut is looking likely this year unless they're able to post some pretty outstanding results. If we look at their most recent investor presentation, you'll see their earnings were pretty disastrous last quarter. The company earned adjusted distributable earnings of just 27 cents per share. Given the fact the company pays 45 cents a quarter in dividends, 15 times 3, that means EFC currently has a dividend payout ratio of 166%. This indicates that the dividend at its current rate is very unsafe, although it doesn't always guarantee a dividend cut. It is possible the company could post some really outstanding results next quarter, and in the meantime use the cash on their balance sheet to cover the dividend if they're interested in doing that. But what's unfortunate for this company is that they've had a history of disappointing earnings over the last year. If we go back to the previous quarter, which they reported back in November, they also didn't come close to covering their dividend here too. It's definitely not a good sign for this company, and unless things can get drastically better soon, the likelihood of a dividend cut I think is pretty high in this situation. The next investment that appears to be struggling with their dividend, although to a lesser extent, is Oxford Lane Capital, ticker OXLC. Oxford Lane primarily invests in securitization vehicles, which in turn invest in senior secured loans made to companies whose debt is rated below investment grade or is unrated. The fund seeks to maximize its portfolio's risk-adjusted total return, and it currently seeks to achieve its investment objective by investing in structured financing instruments, specifically the equity and junior debt tranches of collateralized loan obligation vehicles. There's often some confusion as to what OXLC is, because it's not a mortgage REIT and it's not a business development company. This is something called a collateralized loan obligation fund, and it's basically a closed-end fund that holds CLOs. CLOs are a pool of leveraged corporate loans that are bundled together and put into equity securities, which companies like Oxford Lane Capital purchase. CLO funds typically offer much higher dividend yields than most investments out there. OXLC currently yields about 19%, which is pretty hard to beat among high-yielding investments. That's because these investments typically buy the riskiest CLOs out there because of how much higher yields they offer. On top of that, the amount of leverage that CLO funds typically use can be pretty high, which can either magnify gains or losses depending on the economy and how well the management team has been doing. Just like Ellington Financial, this closed-end fund also pays monthly dividends, which again makes it attractive to income investors. But in their most recent quarter, the company reported significantly lower income compared to their previous quarter. Oxford recently reported net interest income per share of just 23 cents, which gives them a payout ratio of 104%. Now, this isn't too concerning. There's plenty of instances out there where a company's payout ratio was slightly above 100% for a quarter and they didn't have to cut their dividend. I can think of Starwood Property Trust, for example, who's had quarters with a payout ratio that exceeded 100%, and yet they've still never cut their dividend. What also has me concerned here is that this fund has a long history of cutting its dividend. You can see that since 2016, this investment has reduced its dividend from 60 cents a quarter to just 8 cents a month, which is a 60% decrease in 8 years. CLO investments do tend to do better when interest rates are getting cut. So if the feds do follow through on cutting rates this year, that should help out OXLC. But if rates remain high for a long period of time, this fund is going to continue to struggle. And I would just continue to be concerned about that dividend unless they report much higher earnings next quarter. Finally, one more stock that's at an elevated risk of going through a dividend cut is 3M, ticker MMM. They're an industrial conglomerate that provides diversified technology services in the US and internationally. The company operates through 4 segments, which are safety and industrial, transportation and electronics, healthcare, and consumer. Each segment offers a wide range of different products with them that cover a lot of different areas. 3M produces their products in over 65 countries and are sold in over 200, so they basically stretch out across every single place on Earth. They're the oldest company on this list by far, having been founded back in 1902, and today they have over 85,000 employees. 3M is a pretty well-known stock among dividend investors. Not only are they a dividend aristocrat, but they're also a dividend king. This requires a stock to raise their dividend every year for at least 50 consecutive years. And as of the making of this video, 3M has raised their dividend for 65 years. The reason they've done so well is because this company just makes so many different products that are needed regardless of what economic cycle we're in. They offer more than 60,000 products that are used in any possible sector you can think of. They make tapes, labels, cleaning supplies, straps, filters, and the list goes on from there. With this in mind, 3M sounds like a company that's recession or even depression proof. They offer the highest yield out of any dividend king at roughly 6.5%, which is another positive for income-seeking investors. But 3M has also been dealing with a big issue that's been going on since 2016. Right now, the company is dealing with a massive amount of lawsuits stemming from one of their subsidiaries, Aero Technologies, and their faulty earplugs that were used by members of the US military. They manufactured and supplied the military with earplugs to protect service members in training as well as in combat starting back in 2003. A whistleblower eventually came forward claiming that 3M knew that the earplugs they were selling were defective and they didn't meet the standards that the government required. And what's been happening since then has just been a mountain of fees and lawsuits the company's had to deal with. You can see their stock has cratered by more than half in just 3 years, and the situation for 3M continues to get worse. In January, the company's stock fell by another 11% after the management team released some disappointing earnings guidance going forward. Despite this, many investors were still surprised when they actually did raise their dividend in February, this time by just a penny. Although it wasn't much, it was still enough for them to keep their dividend king status. Right now, 3M has a dividend payout ratio of 65%, which given for this kind of stock is considered pretty high. They're also a very mature company that doesn't see much growth in terms of revenue. With these things in mind, especially the guidance they released last month, I'm less optimistic about 3M's dividend. To be honest, although I don't like to see dividends getting cut, if they did cut it, it could actually be really beneficial for this company. But with that being said, that's going to conclude our look at 3 stocks that I'd consider to be at greater risk of going through a cut. Let me know in the comments what you think, but also with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.